Everyone told you the Federal Reserve was going to keep cutting interest rates in 2026. Cheaper mortgages, cheaper credit cards, cheaper car loans. That was the plan. It just changed. Overnight, the odds that the Fed holds rates steady, or even raises them, jumped to over 50%. Not a cut, a hike. And if you have a mortgage, a credit card balance, student loans, or you're planning to buy a house or a car in the next 12 months, this is the video you need to watch. Because what happens at the next Federal Reserve meeting is about to hit your wallet directly. Stick with me, because I'm going to break down exactly why this flip happened, what it means for mortgage rates today, and what you should actually do about it. Not in theory, but in practice. Here's the story nobody's talking about clearly enough. For over a year, the narrative around the Federal Reserve interest rates in 2026 has been simple. Inflation is cooling, the job market is soft, so the Fed cuts. Rinse and repeat. That's what every headline told you. But two things just collided. First, inflation didn't cool the way everyone expected. It's still running hot, well above the Fed's 2% target. Second, the labor market suddenly looks a lot weaker than we thought, with recent jobs data getting revised down hard. Normally, weak jobs data means cut rates to stimulate the economy. But when inflation is also elevated, the Fed can't just cut, because cutting rates while inflation is hot risks setting off a second wave of price increases. That's the trap the Federal Reserve is in right now. Slow jobs, sticky inflation, two problems that usually call for opposite solutions. And that's exactly why markets are suddenly pricing in a hold, or even a hike, instead of the rate cuts everyone was banking on. Let's make this real. If the Fed holds or hikes instead of cutting, here's what happens to your money. Mortgage rates today are already elevated, and if the Fed pauses its cutting cycle, don't expect relief anytime soon. If you've been waiting on the sidelines hoping rates would drop before you buy a house, that timeline just got pushed back. Credit card debt gets more expensive to carry. The average American is already sitting on record levels of credit card balances, and every month rates stay high is another month that debt compounds against you. Savings accounts and CDs, on the other hand, actually benefit. If you've got cash sitting in a high-yield savings account, this is good news for you. That's the one silver lining here. And for the stock market, higher for longer rates make borrowing more expensive for businesses too, which is part of why you're hearing more chatter about a potential stock market pullback even after recent record highs. Higher rates tend to cool off high-growth stocks the fastest, because their future earnings get discounted more heavily when money isn't cheap. So what do you do with this information? 3 things. 1. If you're carrying credit card debt, this is your signal to get aggressive about paying it down now, before rates potentially climb higher. Don't wait for a cut that might not come. 2. If you're house hunting, stop waiting for the perfect rate. Lock in what you can afford today, because there's a real chance rates plateau here, or even tick up before they come back down. 3. If you've got idle cash, high-yield savings accounts, and CDs are still paying well, take advantage of that while it lasts, because if the Fed does eventually cut, those yields drop with it. The bottom line, the rate cuts are coming story that's dominated headlines all year just hit a wall. Inflation and jobs data are pulling the Federal Reserve in opposite directions, and that uncertainty is exactly why you need to stop guessing and start planning around both scenarios, not just the one you're hoping for. If this breakdown helped you understand what's actually happening with interest rates in 2026, hit subscribe, because I'm tracking the next Fed meeting closely, and I'll have the full breakdown the moment the decision drops. Before anyone else explains what it means for your money, drop a comment. Are you team rate cut or team rate hike? I want to see